and welcome to On the Spot here on this, it's a Wednesday morning.
Yeah.
Tony, so I'm doing great. How's the hosting of the show going?
It's going. It's an experience. I give Kaylee Nix a lot of credit because it is not the easiest thing in the world.
It is not the easiest thing in the world as well. And speaking of not the easiest things, you guys were talking about durable goods. We talk about the spot market. The spot market is coming down. Our first image right here is pricing power between carriers and shippers. And for the first time in a long time, we are under 50. 0 gives complete pricing power to the shippers, 100 complete to the carriers. 50 is a balanced market. We are now in the shipper category again.
Yeah, so with this, we kind of think of it a couple ways, right? I mean, the market's been so hot. I think it was 94 weeks, consecutive weeks, that pricing power is in the hands of the carriers. What we've seen on the spot market, you look at the declines, last 2 weeks, it was 27. They've basically fallen 35 cents per mile since the beginning of April. So, you're seeing a rapid acceleration of that downward movement in the spot rate. And you look at rejections under 10%, which they've been above 20 for much of the past year. So, really, you're seeing this real big slowdown in the spot market. Granted, the contract market's still pretty strong, and I don't think there's any denying that. And it's not what we're saying in this pricing power flipping. It's just that kind of shift in balance has changed a little.
It has changed, right? We do have record contracts, but that's the rearview mirror.
Yeah, exactly.
That's not the windshield, and the pricing power index looks out the windshield. And what you have with I don't know if they're record increases, but they're large increases in contract rates is top of the market, right? That happens at top of the market. So you take all these rate hikes on the contract market and you see the spot market fall apart, well, what's the next thing that's going to happen? Yeah. And usually it's between 30 and 60 days with a spot market that has fallen 25%. We did a research paper in 2019 about this. Between 30 and 60 days, you start seeing movement out of the contract market back into the spot market, and that could be shippers going directly to the shop or to the spot market, sorry. Or it could be rebidding.
Yeah.
Rebidding, coming back and lowering the rates on contracts, and that's what we're going to see very soon if we haven't already seen it yet.
Yeah, I think some of the anecdotes that we hear, they're just pushing the bid cycle out, right? They go through the bid, and then by the time they get to the end of it, they're like, oh, wait, we want to do it. We want to go to a tier 2 bid or tier 3. They just keep extending this bid cycle, right? We talked about the shorter bid cycle, which is good on the way up, but it hurts on the way down, right? It's kind of the same way the spot market is when you think about it. You've got this smaller carriers, they basically bid the freight up on the way when the market's tightening and rates go up. Well, on the way down, to keep their trucks moving, they basically bid against each other and drive the rate into the ground. And it's kind of what we're seeing here.
It is. It's that cyclical nature of trucking and rates. It's this up and down. It's not, you don't want to be a zero-sum game, but in some ways it's a market, right? Yeah. So it is a zero-sum game.
Yeah, we'll bring up our next chart. It actually has our truckstop.com all-in drive-in rate. You see it there at $2.94 a mile. And then we've got our band contract rate per mile that initially reported. You kind of see, it's kind of a blip. When you think about contract rates, it's more of a long-term trend, and it's kind of hard to pull away any trend from that short-term little decline that we saw here at the beginning of April. We were at like $2.96. So it's a pretty drastic drop there in the beginning of April. But I wouldn't call it a trend yet, but it is kind of concerning when you see what spot rates have done, even starting back in, say, mid-February.
Yeah, it could be the beginning of a trend.
Yeah.
That's the thing. There's not enough data right there. Things that are happening in real time right now, it's hard to say it's a trend, but it's a beginning of it could be a beginning of a trend, right?
Yeah.
It's certainly not, I guess, a screen shoots for some parties in the market, right? Yep. But it looks like the spot market is going to start, we're going to start seeing it. The contract rate is going to react to the spot market declines that we're seeing right now. And we were keeping an eye on it, but it looks like the spot market, I don't want to say collapse, but it kind of did just collapse.
Yeah, I mean, I know Bank of America released a note yesterday that talked about how this truckstop.com rate ex fuel surcharge is below 2018 levels. And everybody knows what happened in 2018 into 2019 when those spot rates fell. And it's kind of setting up for a very similar impact, especially when you look at how much capacity has been added, right? It may not be the large carriers just going and just expanding their fleets like crazy, but what you're seeing instead is a lot more new entrants chasing those higher spot rates, right? And that's kind of where this.
Yeah, it reminds me a lot of 2019, right? 2019 was nowhere near an economic recession, didn't even get close to it. It was a pretty healthy growth pattern, but it was a freight recession. Load volumes were strong. It was just a lot of capacity in the market. We're probably going to see that capacity in the market, and it takes a cycle, right? It's a cycle of 12 to 18 months to clear that out, to start a new bull market. So it's kind of that's the feeling I have that is how we're moving forward right now.
Yeah, I mean, anytime these cycles, right? I mean, COVID basically caused a short cycle in a very short, or a 3-month span. We went from
it did, yeah.
Like the lowest rejection level to record rejection level to the lowest, and then we've started this runway to where we are now, or were 2 months ago, and now we're kind of coming off those highs. And obviously some of these new contracts coming online are driving some of those rejection rates lower. But you look at the decline in the rejection rate. I mean, we've gone from 20%, right around 20%, 18% to under 10% in 7 weeks. It took that basically same decline from after the winter freeze last year in March, or right there in the middle of March, till the end of the year was about that same decline. So I mean, you're talking a 9-month decline, and we've had it in 7 weeks.
Yeah, I mean, it's a volatile market, and we were talking yesterday, Tony. Corrections aren't soft landings.
Yeah.
Corrections are messy, and we're going to see some messiness in different markets. We're seeing it in the spot market right now. We are going to see it in inventories later this year, I believe. I think you had some panic buying from corporations back last fall, last summer. That's just now catching up. Those inventory levels are going to be out of balance. We'll see what that does to the freight market. But yeah, there's a lot of question marks.
Yeah, I mean,
around inventories, you have inflation, you have fuel, you interest rate hikes, but there's going to be a lot of excess inventory out there, and we'll see how companies pass that through, liquidate it maybe. We'll just see.
Yeah, I mean, we talk about the Shanghai shutdown as well, and those impacts, and it's like, if consumers change their buying habits, right? If these large companies have sat there and purchased all of this stuff to come over, and one, it misses seasons, right? Because I mean, you start running that risk. And then two, you've got a consumer pattern shifting back, more normal, right? I mean, we saw the shift before COVID. We were really service-heavy economy, less spending on goods. COVID caused that shutdown of the services, switch to goods, and now we're kind of seeing all of that reopen, and these buying patterns start to shift again. I mean, March was kind of the first indication, right? You see retail sales were still up a little, but a lot of that was driven by fuel and gas stations. And those numbers aren't adjusted for inflation, so they were actually negative year over year.
They were.
So I mean, that's kind of to me, that's the big concern with freight volumes, right? You're seeing those consumer that's really driven the freight volumes in the past 2 years really start to kind of change their behavior.
And they'll continue changing. I've been keeping up with TSA passenger counts throughout the pandemic because they're fascinating numbers. No masks on airplanes.
Yeah.
I think that's it's a big deal.
Yeah.
It's a big deal. It's going to bring everybody, those passenger counts, and corrections are never smooth. So you might see a lot of people flying, a lot of people paying those fuel surcharges to be on a plane, to go see people they haven't seen, to go places they haven't, they've been dreaming about, they've been watching on TV, on Netflix maybe. They're canceling their Netflix subscriptions and actually going out and doing things. And which means that the economy might be fine, but we'll have a freight recession.
Yeah, so it is definitely going to be an interesting next few months. But that does it for this week's On the Spot. We're going to take a quick break, but we'll be back with more FreightWaves Now.